Thank you all for coming to another workshop of Money Matters. If you were with us last week, we talked about life insurance, and
Mhm.
today we'll talk about investment. So I'd like to introduce you to our guest speaker today. Her name's Natalie, and please welcome her. And Natalie, I toss it over to you.
Thank you, Raul. Hello, everyone. My name is Natalie Flores. As Raul mentioned earlier, we know each other from our Montgomery College years, quite a few years ago. So today I'll be talking about investing. So investing itself could be a whole series of workshops. It's a very there's a lot of nuances, but what I'm going to try to do today is to sort of give you the basics of investing. It's not meant to be an exhaustive lesson by any means, and hopefully I'm also providing you with some resources that you can do some learning on your own. So I'll go ahead and share my screen. If at any point you have any questions, there's a chat box, I believe. Maybe Raul can help me monitor that. And I'll do my best to answer those questions. And so let me go ahead and share my screen then. Share screen. And let me know when you can see it.
You can see it.
Awesome. Okay. All right. All right, a couple of disclaimers. So this presentation is for education purposes. It's not meant to be an individualized investment advice. I'm not telling you what to invest in or what your approach should be. I am not a certified financial planner, guru, or expert by any means. I'm actually a self-taught passive investor myself. And so I'll go a little bit into what that means. The opinions expressed in this presentation are my own. They do not reflect the opinion or policy of my employer or any firm mentioned. So just kind of getting the disclaimers out of the way. And also a couple of reminders as we're going through this. There might be some terminology that it might be the first time you hear, or it might be something that you haven't you heard before but don't really understand. And also, so that's okay. I also want to remind you that personal finance, or in this case, we're talking about investment, it's personal, right? Everybody has different circumstances and everybody's at a different point. So just keep that in mind as I'm going through this. Some things might apply, might not apply to you. Again, also money is emotional. I think that's something that it's not talked about enough. And so if some feelings come up, just be mindful of them. And then, those are things that I can recommend books on as well, and some resources. I personally believe that financial literacy is a social justice issue. I do think that it should be included in curriculum in colleges and in high school. And so I'm really, I think it's amazing that you guys are doing this workshop here and trying to educate, our community about investing and other money matters. And another thing I want to bring up is an article that came out, I think several years ago already, that how 78% of workers are living paycheck to paycheck. And so I want to keep this in mind as we're talking about investing. And you're going to hear me say this again, emergency fund is important. If you never heard that term before, I'm going to define it. But emergency fund, if anything, actually, from this investing, I want you to take away emergency fund. I don't know where everybody's level in terms of investment or knowledge is, but I'll start as if you don't know anything. And so hopefully I'm not insulting your intelligence. So let's get started. All right, so a couple facts about me. I am Peruvian American. I was actually born in Peru, but grew up in Montgomery County, went to Montgomery County Public Schools. I think they're amazing schools. I'm very thankful to all the teachers I had there. I recently graduated from the University of Michigan with an MBA, and by recently, I mean like 2 years ago or a year ago. I have a bachelor's degree in engineering from the Smith College and an associate's degree from Montgomery College, and that's, as I mentioned, where I met Raul. Very passionate about personal finance. Like, that is my favorite thing to read. Like, I have books on books on books about it. And it's mostly because I never grew up learning anything about it, that the extent of the lessons I got at home was make sure you save. And that was it, right? Like, make sure you're saving, make sure you're not spending everything you're earning, and that was it. And so in high school, or I'm sorry, in college, when I would hear my classmates talk about their parents' retirement fund or investing, or how their parents would talk to them about investing, that was something that I didn't get. And so that plus also seeing how the financial crisis of 2008 impacted my family just got me even more interested on financial literacy and just educating myself on that topic. So what is investing? Investing is really putting your money to work for you. It's basically using your money to grow, to make more money, right? You can do that through the stock market, which is the area where I'll focus the most, the bond market. You can do that through real estate. There's also investing on yourself, but through education, whether it's formal in the university or informal through just own self-education. So some things I won't be talking about too specifically about, because those are, again, could be in itself a workshop, are retirement investing. I do touch a little bit on it, but specifically to retirement investing, I know we talk about a lot about retirement savings. And I think when you talk about 401k and Roth IRAs and those, and you hear people say, make sure you're safe for your retirement. I think that should be actually not say safe, because you actually should be investing for your retirement. And I'll talk about why there's a difference between their saving and investing. I won't be talking too much about the bond market or real estate or gold and precious metals. I think those are very nuanced things that I don't think we'll have time to talk about that. All right, so keeping in the subject of what is investing. So investing really happens when a company wants to raise capital, so that's money, for operations or expanding, right? So they do this by issuing stocks to investors, and investors are like you and me. And what that means is that as an investor, you can go to the stock market, and we can talk about the details of that. That's online now, right? To buy a share of that company. And so here, the example I have, like Natalie's throw blanket company, right? So I make throw blankets, I knit, all right, so, and I have a company, but I noticed that there's a lot of demand for my company. And so I need to grow in my operations. And what that means is I need to hire more people, I need to buy more material, maybe I need to rent a space where I can buy more machinery and put there. So I don't have that money. So then I say, okay, well, then I can sell shares of my company, and I'll sell it to Lydia, right? I'll sell it to Lydia, I'll sell it to Raul, and each share it's $10, right? And they get, let's say, either 10% of my company. They get some ownership, so of my company. And so in investing, sometimes when you are researching or reading on it, you'll hear things like stocks and shares, and there are differences between those two things. But for this purpose, for the purpose of just like keeping things simple, they mean really the same thing. And the company decides to, so when you buy a share from a company, so you buy a share from my company, or that makes you part owner of my company. So some companies, what happen is they pay their owners or the stockholders or shareholders a dividend. So sometimes they pay that annually, sometimes they pay that quarterly. So if you buy a share, which is $10 of my company, let's say I'll pay you a quarterly dividend of $1 every quarter, and every quarter is every 3 months. So let's say that so you buy my share in December 2020, which is now, and it's $10, and I do really well. My company does really well. Like I'm selling throw blankets left and right. You know, Target is like, hey, Natalie, we need those blankets. And so I'm expanding, I'm growing. And so the value of my company just increases so much. And so when you are, so let's say it's a year later, so it's December 2021, the price or the value of the share you bought is a lot more. So you bought it for $10. Now it's December 2021, and that value, it has risen to 100. And so you decide, hey, I'm gonna sell this because, you know, I want to make, I need some money, so I'm just gonna sell it, or I want to invest in something else, I'm going to sell it. And so you bought it for $10, and now it's December 2021, so it's a year later, it's $100. So the difference is $90. So that's what we mean. You use your money to make more money, right? So you just made $90 more. So hopefully I'm not insulting your intelligence with this very simple example, but I'll pause there just in case there are any questions. Okay, so let's keep going. And so this is just a visual of what I wanted to show you, how a company could divide the ownership of that company into shares. So just think about this little square as a share of that company. And so that is what they're selling, and that is a fraction of the ownership of the company. So sometimes people will say, you know what, I'm only going to buy 3 shares. So if there are 100 shares in this company, then you're 3%, you own 3% of that company. Some are able to buy less, some are able to buy more. If you heard something say like partial share, sometimes the cost of one share, like for example, Amazon's in the 3,000s, I believe now. I can buy $3,000 worth of one share, but there are certain things called partial shares, which allows you to buy a fraction of that share. So that's a little bit more detailed, but this is a nice visual, I think, of how you can think about ownership of a company.
I have a question.
Yeah.
This means you're talking about like a stock?
Correct. So stock and share can be used interchangeably in this case. So in this case, you can think about like a stock. So I'm buying 3. The correct terminology would be that I'm buying 3 shares, but it is stock. Stock and share in this case could mean the same thing.
Yeah, but stock all the time, the value is up and down, right?
Yes, that is correct. So the value changes of the stock all the time. And we'll go into the details of that. But that is a very good point. So if I give you an example here, you bought stock from my company at $10, right? And it's December. And then in January, let's say my factory goes on fire. And so it no longer is that valuable. And it goes from, or not as valuable. So let's say it goes from $10 to $5. So on paper, you lost money, right? Because like the value of the share is now $5, but you pay $10, but you haven't sold that share yet. So you actually have not, what they say, you have not realized that you have not realized that loss yet. So it's, if you sell it, then yes, you lose the money. But if you just still hold on to that share, you can wait and see like, okay, is her company going to get better? Is she going to go worse? And so that's a little bit of a risk, and we'll touch on risk a little bit later on. But it's true what was said, that the stock value of a company goes up and down, up and down, up and down, and I'll show a graph of that as well. Okay, so here it is. Here's the graph. So for example, this is a 1 month view of Zoom, which is what we're using, right? The company like Zoom, this is a technology we're using now. It's a company. So on November 12th of this year, if I bought a share or a stock of Zoom, it was going to cost me $428.64, right? So that's what I was going to be. That's 1 share of Zoom. Now, if I would have sold on November 30th, 2020, the value of that share was $478. So if I bought at this point and sold at this point, I made a profit of almost like $50, right? Like $49.72 in profit. However, as was mentioned, the value of the share goes up and down depending on the demand for it. All of this is really the demand for it. Just think about it as when toilet paper, everybody wanted toilet paper, the demand or the price went up because everybody wanted it. But then now let's say nobody really wants it. And so the price of something goes down. This is similar to that. It's supply and demand. So at this point, everybody wanted Zoom. Everybody's using Zoom for work, for school. So like the price is going up and up and up. But does anybody remember what happened around this time of like after November 30th? Or I think it was on November 30th.
I think it's lost.
So what
Lose
happened?
money?
So
Is
they,
lose money?
so they didn't lose money. So what happened on November 30th, there was on the news, there was an announcement of a vaccine, of a possible vaccine. And so the market reacts to news like that, like, so when there was news that the vaccine was successful or trials of vaccines were successful, then people started to sell the share, like the price of the share went down because people thought, oh, maybe we're not going to need Zoom as much, so it's not going to be as much in demand, right? So it's kind of like, let's say it's really cold right now, right? So if I sell you a scarf, I'm probably going to try to sell it to you, let's say like $20, $25, right? And the colder it gets, the more I'm going to raise the price of that scarf. But in summer, if I tell you, hey, I have a $50 scarf, do you want it? No. You don't want it because there's no demand for it. So you can think about it similarly like that. When the news of the vaccine came, people thought, hey, we might not be using Zoom anymore. So it doesn't mean that the company lost like operational like money, like they lost money and like an investment. It's just that people value that company less. And so let's say that I panic and I was like, oh my gosh, the vaccine is coming. So I don't want to lose money in my share. So I'm going to sell the share, and I sell it on December 1st. And so the value of that share now is $406. So then I actually lost $22 because I bought it at 428, and now I'm selling it at 406. So any questions? Because this could be confusing. So, okay. So I'll keep going then. So we talked about risk, right? So I just show you that depending on when you buy and when you sell, you could lose or you can gain some money. So there is a level of risk to investing, and there's really no avoiding it. There's only ways to mitigate it, which means to reduce the amount of risk. And so this is the risk triangle, very sophisticated triangle. And here I'm just giving you examples of other places where you can put your money that are less risky, but it also means that you get less return or less money back for that money, right? For that value. So like bank accounts, checking accounts, you most likely have 0% interest checking account. It doesn't give you any interest in that checking account, or even like a savings accounts. They're very, very low. They're under 1%. I think right now they're around 0.6%. Treasury bonds, very safe because the U.S. government, the U.S. economy, kind of safe. so the government guarantees those bonds. So it's also like less risky, but again, you don't gain a lot of money. Something that's more moderately risky is a mixture of stock and bonds, and I'll talk about that in the next couple minutes. And then the most risk is something like buying an individual stock, which we talked about Zoom, right? That's an individual stock. And so if you put all your money, all your investment money into that, you are solely dependent on whether that company does well or it doesn't do well. So let's say the CEO of Zoom, that's something that creates negative publicity to the company, that could impact the value of the share. So you're solely dependent on that on that company. That's why it makes it more risky. So however, one ways to mitigate, to reduce that risk for your own financial well-being is, one, to diversify. So what that means is, it basically means don't put all your eggs in one basket. So the example is like you have a basket and you put your egg there, you put all your eggs there, and that falls. You don't get an omelet. Everything's on the ground, right? Everything's on the ground. But if you have an egg here, an egg in another basket, an egg in another basket, and like one falls or you drop one, you still have other eggs left over, right? And so what this means in terms of investing, it just means that, so if you invest in one company, so like say Zoom, let's say you also want to invest in a different industry or a different type of company, right? So let me think of, let's say people who invested in airlines, if they had all their money on airlines when COVID started to happen, the value of their shares went down. But let's say they also invested in paper companies, right? Paper companies that make packaging, that make toilet paper, that make everything paper related. And so like that probably is going to go up. So one goes down, one goes up, and it's kind of balancing it out. And so you don't lose a lot of money. And again, you only lose, and this is something very important that I didn't write down, you only lose if you sell your share or you sell your stock. Otherwise, it looks like you're losing, but you're not really losing yet. So the other way to mitigate the risk of investing is to have an emergency fund. And so this is very important because you don't common or best practice, common recommendations out there is that you don't don't rely on that particular investment for your emergency. So let's say I'm driving, my tire blows up and I have to fix that. If I invested that in Zoom and I needed that money on this date, and my tires will cost me up higher than $500, then I don't have enough to cover that, right? So that's why it's recommended that you have an emergency fund on a savings account, that you're not investing that, it's not risky, you're keeping it safe, and that should be separate from the money you invest. So investments, they usually recommend that you invest for the long term. So that means everybody's different. For some, it means long-term is a year, so I need the money in a year. For me, that's not long-term, that's short-term still. But for others, it's 3 to 5 years. So if you're investing, let's say you want to save money for a house that you want to buy next year, chances are that you probably should not put it in the stock market because you don't know where that market is going to go. But if you're saving, you want to invest for a house in 10 years that perhaps you want to buy, or if you want to invest for your kid to go to college in 10, 15 years because your kid is still in elementary school, that is long-term enough that you should consider investing in the market. But if it's, I want to say if it's less than 3 years, really think about it, particularly if it's a year, really think about it. And I learned this lesson this past summer. I had, so my wedding was supposed to be scheduled for May 2020. And I said, I just sell some stocks that I have, and then I'll pay my wedding with that. Well, guess what? The market went down in March, and I should have sold that a long time ago in preparation for my wedding. And so then I was sort of in a hard place thinking, all right, do I use my savings for that? Or how do we figure out that cost? So I even made that mistake thinking like, oh, the market just keeps going up and I'll just sell later. I'll sell closer to my wedding. You just don't know. So I know I'll belabor this a little bit, so I'll keep going. The other one is pay high interest debt first. So this means like credit cards. Credit cards, again, interest rate for credit cards, like the lowest I've seen are like 15%, but they're almost around the 20%. So the market, yes, there's a chance that you could make money, but it will probably not be 20%, right, that you're going to gain. And so I'll go into a little bit more detail about that, about credit cards, but that is sort of what is recommended sort of before you start investing, is to make sure that make sure you're diversified and make sure that you have an emergency fund. And then if you have high interest debt, like credit card debt, think about aggressively paying those. I don't want to say before investing, but typically that's what is recommended before investing. But I know also individuals that have started down a little bit of both. So diversification, we really went over it, and I'll talk about it more as we go on. So for it, on the top right here, you see this is Zoom, the value of the stock, that it went up through the year. So this was at January. So in January, if you bought it in January 10th, it was $73. And then you see how it goes up and down throughout the year. And now it's valued at $412. And so, but at the bottom, you see American Airlines that around January, it was valued maybe under around $27, but now it's only $17. So diversification can be thought about like you buy you buy a stock in one company and you buy a stock in a different company in a different industry. So so that way, like your losses, the money that you lose on paper is not as big, right? And so I'll pause here because I know this could be confusing. I know I was confused when somebody explained it to me. So any questions?
Is there like a suggested minimum that you should invest? Because that was going to be my other example too. Like, what if I wanted to invest in travel? I mean, everybody loves to travel. I'm sure that traveling will go up as soon as this pandemic is over. Uh, you know,
That's a good question. So travel, so the way that Raul asked that question, he's asking about an industry, right? So there isn't a stock called travel, but there is an industry of travel, and that includes like the airlines, the hotels, the cruises. So so he's asking me, hey, when is it? I guess like how much you should invest. How much is really depends on your financial situation. So I can't tell you like invest 10%, 20%, 5%. Depends on your situation. But you are right that chances are that travel will probably go up. It could go up as quickly as, let's say, early next year, or it could go up as long as like end of next year. So, you know, you just have to understand what is your risk tolerance in that sense. Like, are you investing money that you need within a year, or are you investing money that perhaps to you is like, all right, I don't need this money for a couple of years, so I'm going to invest it. But that's a good question. All right, so I'll keep going. Emergency fund, I talked about it. And now here's another link to an article that said 47% of Americans actually cannot cover $400 of an emergency. Again, I gave you the example of like, hey, you need new tires because something happened on the road, right? 47% of Americans cannot cover $400 of an emergency. And so this is very important. And so this is why I belabor the message of emergency fund. Just have an emergency fund. The recommended advice out there is to have 3 to 6 months of living expenses. And so this doesn't mean like going out to dinner, right? So this means like rent, utilities, things that basic, groceries. And obviously for many of us, this is a lot of money. This is a lot of money that they're suggesting for us to save. But I guess I don't want to overwhelm you, because you can start as small as $100, right? Like just start as small as $100. The key thing is here just to have a little bit safe in case of an emergency, and just give yourself little milestones along the way. And this is to cover things for like emergency is not like, sometimes I think wanting a brownie is an emergency. That's not an emergency, right? An emergency is when you lose your job, their medical expenses, your fridge goes out and you need a fridge at your house, or tires, as I mentioned, right? Like, and so that's money to be put away. All right, and then paying high interest debt, I covered this a little bit. So on average, investing in the market in a stock, or I'll go into what index funds and mutual funds are, gives you around a return, which is money back to you, between 6 and 10%. That's sort of like what the average has been. But I also mentioned that credit cards charge you around 15 to 20%, if not more. So that's why it's recommended that you pay high interest debt first, or you focus on that more than investing, because you could be making 10% on the market, but you're still paying like 15, 20% on credit card debt. And so you're still going to be in the negative. So that's why that is recommended. All right, so I talked about like how to sort of set you up before investing. But why? So I talked also about like the risk of investing, right? And so you could be saying like, well, why should I invest in? You know, it's risky. There's a level of risk. You know, isn't savings enough? And so here's when you'll hear the word inflation, right? So like saving your money under the mattress, or in a tin can, or in a piggy bank, how much interest does that give you? So when you check that money again, I put $100 into underneath my mattress, and I check back the year later, there's still $100 there. I didn't gain any interest on it. And why is that bad, right? Like I didn't lose any money, right? And so the reason it's not ideal is because, as you can see in this image of the coffee cup, over time, your money loses value because of inflation. So in 1970, you could buy a cup of coffee for 24 cents. And I'm guessing this is like not a Starbucks coffee, because Starbucks is obviously like $4 or $5 now. But this, let's think about this is like perhaps a McDonald's coffee cup, right? So you could buy it for 25 cents or a quarter. And then in 2019, that's actually closer to $1.60, right? And so with time, the value of your money goes down, so you can buy less and less and less. And so that's why investing is important to do, because savings is not enough, particularly when you think about retirement. And so here on the left side, I gave you a screenshot of high yield online savings accounts. And so it's basically a savings account. High yield just means that you have a higher interest rate than perhaps on other banks. And so as you can see here, Citibank or Ally, they give you under 1% interest on your savings. So that's not a lot. So that's not a lot to grow your investment for retirement or for education for your kids later on. So questions here on inflation or high yield savings account? Okay, so I'll keep going. So who can be an investor? Everybody can invest. You don't need to have a lot of money to invest. Actually, you can buy some shares for, as we saw for American Airlines, I think it was $13, under $20. You can buy a share for that. If you have a 401k or a Roth IRA, you are already an investor. You're most likely investing on something, although these are accounts, those are not investments, and I'll go into detail about that. And if your job offers a 401k, and particularly if they match, if you hear something that they match you, so if you invest 5%, they match you they match you whatever you invest, take advantage of that. That's free money. And again, that could be a workshop in itself, so I'm not going to go too much into it. But anybody can be an investor. And this is something that it took me a long time to even try, because I was scared. I was like, I don't know what you're talking about. This is scary. I'm going to lose my money. And so the single one piece of advice that I would give my younger self is to start investing then, because there's a saying that says the best time to plant a tree was 10 years ago, and the next best time is now. So it's the sooner the better, because then that gives you time to grow those investments. All right, so how do I start? How do you start investing? And this is, again, something that people told me, even when I was younger, hey, you should invest. Okay, well, I don't know how. So I need to know, like, what are the steps? And so the first step, and it's to select a brokerage firm, or so what that means is kind of like saying choose a bank, right? Except that this firm or this bank or this company is going to buy and sell investments on your behalf. So why can't you do it yourself? We're not really in the trading floor, let's say that, right? Like we don't want to be the ones yelling, sell, buy, like, so we want somebody else to sort of do all that transaction for us. And so that's why you have to select a brokerage account. And so that brokerage firms, here are some examples of them. They're Vanguard. I've been a customer of Vanguard for a long time. I really like them. Fidelity, Charles Schwab. There's and they're newcomers, right? Like Alvest, that I've heard great things about. And so these are brokerage firms that you can create an account, and you can create an account and then start investing through them, right? And some of the things you'll need in order to open an account with them, and you can do it online, is you need your personal information, date of birth, things like that. You need a social security number or an individual tax ID number if you don't have a social security number. And you need identification. That's something that's required for these banks it's just regulation. You also need your bank information. So like your routing number or your account number. And why do you need that? Because you need to link your bank account to your brokerage account. And so why do you need to link them? Is because your brokerage account would ask you, hey, you want to invest in, or you want to buy this stock or the share. how are you going to pay me? How are you going to transfer me money? And so you need to transfer money electronically, and that's why you need your routing in your bank account. Any questions? All right, so I'll keep going. I actually wanted to talk about this slide before the other ones, but I kind of put them out of order. But the next real step, so you have your brokerage account or your brokerage, you open an account with, I have an account with Vanguard, I open my account with Vanguard. And now I really have to think about like, all right, so there's a lot of ways to invest, right? We talked about picking an individual stock, right? So in this case, we talked about Zoom a lot. And then I'll talk about what traditional mutual funds are and index funds. And then there's also hiring somebody to do this for me. I don't want to think about it. I want to hire someone to just tell them, here's my account, like figure it out for me. So all of those are possible ways to invest, right? There are advantages and disadvantages to each approach. So let's say you don't want to do anything. Like, it's kind of like hiring somebody to come clean your house. I don't want to clean my house. I want somebody to come and clean my house. I'll pay them. And so you can hire, on the right side, as I say here, like a financial advisor to manage your investments. This is an option, but it's sometimes it's typically a very expensive option for an average person. So somebody who's going to manage your account is going to charge you for it, and they might charge you a certain percentage of it, and in the long run that could be significant. And so and sometimes these individuals want you to have a lot of assets or a lot of money, right? Because they're charging you a percentage. So if you tell me, Raul says, hey Natalie, I have $100 for you to manage my investment, and I charge you 1%, I'm only getting $1. And I need to make a living too. I need to feed my family, pay my bills. So $100 is not worth it for me. So then let's say, Barbara comes to me and she says, hey, Natalie, I have $100 million for you to manage. Yes, Barbara, I'll do it. I'll charge you 1%. That's a lot more money than 1% from $100. So that's why it's not typically a affordable option for the average person. Definitely not for me. So I'll go to the other extreme on the left side. Well, all right, I don't want to pay anybody to manage my money. I'll do it myself. I'll pick my stocks. But the problem with this, or the disadvantage with this, is that the advantage is that you have full control. You can see where your money is going, but the disadvantage is that you have also full responsibility, and it's also a lot of work. So picking stocks is not as easy as just saying, like, I just buy Apple and Amazon. That is a possibility. You can go with companies that are already well established, but typically the people that are successful in picking individual stocks do a lot of research. They're reading the financial statements of those companies, and they're seeing, like, are they going to grow? Where are they growing? What are the risks of this company? Let me jump into their quarterly calls to understand, like, their strategy and where they're going. And so that's why picking individual stocks could be risky, right? And so that's why it's also not typically recommended for the average person, because I certainly do not want to sit on calls and review all these financial statements to buy a stock. I could listen to, let's say, a friend that tells me, hey, Natalie, I heard of this drone company you should invest in. It's only $100, and you should throw your $1,000 into that investment. And if I don't do my own research about it and I just trust my friend, I could do that. And I could get lucky and that could grow. But there's also that risk of perhaps that person didn't really know what they were talking about. So just like be mindful of that. So my approach personally, and what has been typically recommended for the average person, is to go into invest in mutual funds or investment funds. And I'll go a little bit more detail into that. I'll pause here before I continue. Okay, so what is a mutual fund? A mutual fund is a type of investment that pulls money together from many different people, and they invest in a mixture of stocks and bonds. So what does that mean? So I want to buy, let's say, stocks on all of these, or shares of all of these companies, because they're all like established world companies, but I can't, because I don't have the money to buy individual, like, for all of them. So a mutual fund is really like everybody puts money into this fund, and the fund itself gets shares of those companies. So that's what a mutual fund is. A mutual fund, traditional mutual fund, is typically managed by a professional. So in this case, let's say I'm the professional and I say like, all right, Barbara, Lydia, Adaris, sorry if I'm pronouncing your name, and Raul, hey, why don't we all put money in this bucket and I manage it and I buy the stocks for you. And so that's what it's called by actively manage. There's a manager managing what is being bought, what is being sold. And so again, in a traditional mutual fund or an actively managed fund, I need to get, as a manager, as a fund manager, I need to get paid for my job. I'm doing the research of what companies we should buy. I'm doing the research of when I should be selling this. And so it is not free. A mutual fund is not free. And and the way they charge you, it's called an expense ratio. And that's really just means a fee. And so the average fee is around 1%. And so this means that I will charge you $1 for every $100 that is in your investment. So when you see when you see expense ratio in any investment, whether in a mutual fund, because stocks won't have this, it's mutual funds who will have this. Just pay attention to the expense ratio, and that just means fee. So another special type of mutual fund is called index fund. And again, similar to the mutual fund, because it's still a mutual fund, it's everybody, you pull money with strangers, but there's no professional managing this fund, this account, like this pool, right? And so on the traditional mutual fund, I'm saying like, all right, Walmart's doing good. I'm going to buy more Walmart. Chevron's not doing great. So I'm going to sell Chevron. And I'm doing all my research, my calculations. I'm looking through all those financial statements, sitting on all those calls, and I'm making those decisions. So I need to be compensated for that. In an index fund, it's all an algorithm, right? It's an algorithm. It's sort of like some rules were already set in place. So the manager, so I'm not in it. Like I might look at it once a year, but that's it. Like I'm not actively researching and doing all this job. And typically index funds are created so they mirror or they match other bigger funds, right? And so such as like the Dow Jones, if you heard what the Dow Jones, it's just a list of the 30 largest companies, and they include Johnson & Johnson, Boeing, American Express. Another index is S&P 500, and that just means it's a list of the top 500 like companies, right? And then there's also Vanguard Total Stock Market Index, and that just is a sort of like you have all the entire market of the biggest companies in the US in this index. So basically in this fund, there's shares from all different companies, from all the companies in the US, right? I'll continue, but then I'll pause for questions because I know this could be confusing. So in this fund, even though there's no manager, right? There's no manager managing this, doing the research. There's already an algorithm who's making all these decisions of what to buy, what to sell. It's still, there's still an expense to managing this, right? To the administration of this. So even though it's not free, it's a lot cheaper than a mutual fund, and it's a lot cheaper than an actively managed mutual fund. Again, you'll see something called expense ratio, and the average expense ratio is 0.15%, 0.15%. So that's 15 cents for every $100 that you have in that account. So like if I go back, this was 1%. This is charging you $1 for every $100. This is not even 1%. This is like a fraction of a percent. So commonly index funds are recommended for people just because they are more affordable. They charge you less. I'll pause there because it's a lot. For any questions, please ask.
How long do you typically let your investment roll before you say, no, you know what, I want to sell this now? Or just is it that constant buy, sell, buy, sell, buy, sell?
So for example, I invest in an index fund. And so what I do, I invest a little bit every month, right? And so I don't have plans for that money until like 5 years later. So that's when I plan to sell. But I guess index funds and mutual funds are not meant to be like are not meant to be for day traders, and I didn't add that to the vocabulary here. But day traders are basically individuals who are looking to buy low and sell high, and they're paying attention every day. They're like, all right, American Airlines went down, so I'm going to buy it. And then the vaccine is being successful, so I'm going to sell it. So I'm going to make, let's say, $10 of profit, right? So they're actively paying attention day in and day out. They're day traders, and that requires just a lot of investment from time. I want to do other things with my life. So I invest in index funds that allow me to sort of like regularly invest a little bit. And I actually invest in a total stock market. So which just means like it has stocks from different companies in the US, different industries, small, big. And so the reason I do that is because with time, it's been shown that it goes up. It doesn't go up as quickly as like the Zoom curve we saw, right, for Zoom. Or if you Google Tesla, you'll see how much that has gone up, but it slowly goes up. And so in terms of like how often you should do it, it's really up to what you're comfortable with, but my recommendation would be like to invest for the long term. And so it's not meant to be a day trading activity. And that could be on a whole nother workshop if you want to focus on day trading. And I'm not a day trader. I have friends who are day traders, and I can ask them to see if they're willing to come and give you more details on that. Any other questions? Okay. I know. Oh, yeah.
Do you have any information on the difference in return between the index fund and the actively managed mutual fund? Is there information that would suggest that one has a better return than the other?
So there is definitely information out there. I don't think I added it to the presentation, but it's based on my research. It shows that actually actively managed accounts don't do that much better than index funds or passively managed funds, mainly because it's almost like, unless your fund manager is like Ray Dalio or Warren Buffett, typically on average in the long term, they do about the same. And so that's why index funds have become very popular in the last, I want to say the last decade for sure, but longer than that. And I can send you like research on that if you need to. All right, and so in terms of expense ratio, you might think, and I'll go super fast because now we don't have a lot of time. You may say, oh, well, it's only 1%, right? Like that doesn't seem like a lot. Well, if you invested $1,000 and the return on that investment is 6%, and there's no fee, let's pretend there's no fee, you would make in 30 years, that money will grow to $5,743. But obviously, if you're investing through a brokerage firm, they're going to charge you a fee, an expense ratio. And so on the top right here, if they charge you 1%, your $1,000 only grows to be $4,248. However, if they charge you 1.5%, your money goes even lower, right? You only grew your money to $3,600. If it's 2%, lower 3,000, and if it's 2.5%, it's actually under 2,600. So that's why expense ratios are important to pay attention to. It's recommended that they should be under, the lower the better, but definitely under 1% would be my recommendation. And here's something that you can, I took a snapshot of like Morningstar for different funds. On the left side, you see an actively managed fund, and you see here the expense ratio. They'll charge you, if you go with this actively managed fund, they'll charge you 0.79%. So it's actually less than 1%, which is good, right? It looks good. But if you compare it to an index fund, you see how it's 0.015. So it's even a smaller fraction than 1%. And so if you invest in this side, on an index fund, it's even less what they would charge you. And again, this is because the actively managed fund has a fund manager who's doing the research. They're making the calls of what to buy, what to sell. And so the idea is that they will actually outperform the market. And so that's why they're charging you more. In an index fund, the idea is actually not to outperform, but to match the market. And so, and everything's run by algorithms. And so that's why they are able to charge you less, because they don't have a person actively looking at this all the time. So hopefully that provides a little bit of clarity. And I know we don't have a lot of time, but here I just wanted to kind of distinguish between investments and account types. So some people, when you ask them like, hey, what are you investing in? And they say, I'm investing in a 401k. A 401k is not an investment. A 401k is an account. It's like saying a savings account or a checking account, right? What you're investing in the 401k, inside the 401k, so the 401k is a bucket, and the investment's what's inside of it. So 401k, you can have stocks, you can have bonds, you can have, index funds in it, you can have, or it could be a target date fund. And so this is something important to understand. And so just want to make sure that folks understand that difference. So for example, like the 401k can have cash equivalent, can have stocks, can have bonds, a mixture of index funds, or it could be a target fund. Same for an education investment plan, like the 429. It could be a mixture of stock, bonds, it could be an index fund, it could be a target fund. And so this is the bucket, and this is the investment that goes inside that bucket. Now I'll share what I do, because I mentioned earlier that I am a passive investor. I don't want to do all the research. I don't want to sit on it. I also cannot afford to give my money to somebody to actively manage it. So I just do a target fund. So I'm going to retire around 2050, and I set up my account with one of the brokerage firms that I mentioned earlier. And I said, you know what? I don't want to think about it. I don't want to recalculate. I don't want to think about diversification. You do it for me. And I don't mean like a person, I mean like the company does it for me. And so you can pick something called a target date fund. So I'm going to retire around 2050. The closer I get to that date, the firm is like, all right, we're going to reduce the risk. So we're going to have more bonds, have less stocks, the closer we get to that date. And I set it and forget it. I invest in it like every so often, and then I set and forget it. And then I mentioned a total stock market index fund. And so you can find this through different brokerage. Fidelity has it, Vanguard has it. I'm sure Charles Schwab have it. And so it's basically, it provides a diversified exposure to like small, large companies in the entire US stock market. So the idea is that the entire US stock market is going to go up, right? So you're not dependent on Zoom doing really well. You're not dependent on Delta doing really well. You're dependent on everybody kind of doing well. And I know we're 1 minute, but I'll leave this here in terms of asset allocation. The advice, this is an investment strategy that says like, subtract your age from 110, others say 100, depends on what your risk tolerance is. And that's what should be invested in stocks. So I'm in my 30s. So this, according to that, it says I should be 80% invested in stocks. It doesn't tell me which stock, right? Because that's not what the point is. It's just telling me 80% should be invested in stock, 20% should be in bonds, because bonds are safer. And again, we didn't talk about the bond market. That could be a different workshop. But bonds are typically safer than stocks. And so this is an investment strategy. This is not the law. This is not telling you this is what you should do. It's a recommendation. And I'll skip over this. You can read on it yourself. I share with Raul so he can share with you. But I definitely want to recommend this book. This is very important. As I mentioned, I am a self-taught person. I'm not certified anything. I know, I don't work in investments either. And so, but these are books that have changed my life, particularly this one, I Will Teach You to Be Rich by Ramit Sethi. Highly, highly recommend it. Simple Path to Wealth is basically being a passive investor. Highly, highly recommend it. This will break it down, like what is investing, tell me step by step. And so if you like podcasts, here are some of my favorite podcasts. I try to be as diverse as I can, so whatever speaks to you. And then there's some really great YouTube videos out there, and here're some of my favorite 3 that I share with everybody, and I'll give this presentation to Raul. But investing could be scary, but it's not that scary. I definitely want to encourage you to do it. But again, emergency fund first. And that's it. Thank you so much.
Thank you, Natalie. I wish I should have invested sooner.
Well, the next best time to invest is now, remember. So
Thank you.